Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, U.S. stocks searching for direction as investors size up the Fed's next moves. We've got full market coverage ahead. Plus, NVIDIA is preparing a new, more powerful chip to sell in China. Today's investor playbook dedicated to all things AI. And we'll size up the health of the economy and the housing sector with investor Meredith Whitney. All that and more coming up on Market Catalysts. First up, let's get a check of the markets and take a look at the major averages here, where we continue to see a mixed picture. We've got the Dow trading higher by almost 150 points, a third of 1%. The S&P 500 just kind of flatline almost today, and the Nasdaq is down 0.4%. We of course see the effect of Home Depot in this market, where we've been seeing it's somewhat under pressure. And on the flip side, of course, folks are waiting for Jackson Hole and Federal Reserve Chair Jay Powell's speech later this week. Speaking of which, let's take a look at the bond market as well. There too, we are not seeing big movement, just coming down a little bit across the yield curve. The 10-year right now at 4.31%. Well, at a recent dinner in San Francisco, OpenAI CEO Sam Altman suggested a bubble could be forming among artificial intelligence stocks, comparing the soaring excitement with the dot-com bubble. Altman said, quote, "Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes. Is AI the most important thing to happen in a very long time? My opinion is also yes." Those comments first reported by The Verge. And joining me now with her take on the AI trade is Nancy Curtin, Alti Tiedemann, Global Chief Investment Officer. Nancy, it's great to see you. So when you have somebody like Sam Altman, who, by the way, some could argue even in private markets that his company's valuation is a bubble, how should public market investors be thinking about this? Are these AI stocks in a bubble?
I mean, first of all, let's just talk about OpenAI's this $500 billion valuation at the most recent round. So that's a rather eye-popping number. Having said that, in the private market, and these large language models are scaling in ways that we've never seen before. Like, how do you get to 100 million in revenues in 2 years? You'd be a very popular, chat box, large language model. So the scaling is just exceptional. That doesn't mean that these are the Anthropic and OpenAI will be the winners, but there was a recent Anthropic raise, $170 billion valuation. It was 10 times oversubscribed. So I don't see investor interest waning here, but I think people are trying to pick through the winners and losers. Just a second, on the Mag 7 by way of example, they've all rallied, since the April lows, but I think investors are being more discerning. Let's take a look at what's really rallied year to date. Step back, it's three stocks. Maybe it's the AI trinity. It's NVIDIA, of course, a leader. It's Microsoft that saw cloud revenue up 39%. Okay, so some monetization benefits from all this CapEx spend. And it's Meta that has proven its ability to use AI to get more engagement in its platform, its various social platforms. So I think investors are getting more discerning, and I think AI is spreading just beyond the Mag 7, and Mag 7 itself is a bit of a mixed picture, right?
Yes, it definitely is. We keep talking about whether we should even talk about them as Mag 7 anymore, but we'll leave that. We'll leave that discussion for another day. That said, inevitably there must be some stocks that will not be winners that people have been piling into, and so I guess when you're trying to figure out where to go as an investor, how do you figure that out? Given that if this is such a big opportunity, it's also a difficult to predict opportunity.
Yeah. So one of the ways we're thinking about it is being with a technology manager that has an eye on both public and private markets. You need to know what's going on in both of these. You have to have a lens in both. The disruption, the changes that are happening are just extraordinary. So that's number one. We do think there will be winners and losers. And maybe one good example of that is the equally weighted semiconductor index is up, 14% this year, and software index is down 7%, and you've got Salesforce and Adobe that also are quite down sharply. So I think investors are recognizing, software is free. Do I need to pay for these large software companies? Now, look, we think there will be applications that will arise as a result of Gen AI. We haven't seen it. Our playbook has been, as I said, a technology manager with a lens in both public and private markets, but also investing what I call the digital infrastructure layer and power as well.
Yes.
I always say there's There's no Gen AI without EI, energy infrastructure, and that affords a lot of interesting and diversifying opportunities for investors.
Yeah, that's something I wanted to ask you about too, because we've seen the industrials, for example, see a big rally, and many of those are those power equipment suppliers. So GE Vernova, for example, which has done so well. The power companies themselves, the utility plays, the power generation plays. There too, though, how do you figure out? Do you just go in and buy them all?
No, I think you have to be discerning, so I don't want to talk about specific stocks, but you're spot on. Let's look at the outperforming sectors this year. It's obviously communication services, think Meta and Alphabet. It's technology, think NVIDIA and Microsoft, but it's also industrials, Parker Hannifin, Caterpillar. Lots of these industrial companies are seeing booming demand from Gen AI. They're also benefiting as well, the industrial sector, from the tax bill, which I think is quite interesting as well, and I think we should touch on that. So industrials, Gen AI theme, and utilities, right? Demand for power was flat over the last decade. It's probably going to go up 25% over the next 5 years. So this is something that's really quite extraordinary. You want to have your foot in both of them. Obviously, you need to be selective in terms of what you choose, but I think it's quite interesting to see Gen AI broadening into the other sectors.
Okay, so you mentioned the tax implications. Give me more details on that and who it could benefit.
Well, first of all, I think what's quite interesting is we're entering a world in which we are both expansionary from a fiscal and monetary perspective. That's quite positive, because normally fiscal and monetary policy go in opposite directions. If we get the Fed cutting September, the tax bill's expansionary, Fed cutting, let's think about that. That's quite interesting from a stock market perspective. But getting back to the tax bill, I think less covered was the fact that there were these permanent tax benefits for business. 100% bonus depreciation, great for CapEx, and 100% expensing of R&D. So this is really powerful. It means that the effective tax rate, which is like an accounting thing, okay, that's on your income statement, the actual tax that people pay is what happens in the cash flow. And the cash tax rate, some think could come from 21%, the effective tax rate, to about 10%. So who is this going to benefit? Well, already take a look at the earnings of AT&T, Verizon. They talked about billions of dollars they're going to save as a result of the tax bill. So you look at the tax bill, deregulation, onshoring of production, and the investment related to Gen AI, and we think investment spending, CapEx, could really surprise on the upside next year. That is the surprise for 2026 and 2025 and beyond.
What's the biggest risk out there then? Because everything you're talking about is pretty positive. Is there anything that could sort of upset those positive fundamentals?
I think if you have fiscal and monetary policy, both expansionary, you have a huge investment spend happening. The risk is that the economy runs too hot, right? And we get inflation. Now, the key will be watching productivity. The key is the 1990s playbook in which the economy was able to run hot because productivity went up to 3%, and that means you can get more growth with less inflationary pressure.
But so far, we haven't been seeing that sort of the promise of AI feed through to productivity, right?
I mean, productivity in the United States is 2.2%, so it's not bad, right? That's like 2 times any other economy in the world, in the developed market side, Europe, Japan, by way of example. But I think it hasn't fed through, but with this kind of CapEx spend, and with enterprises all thinking about how we're going to adopt Gen AI in terms of efficiency and automation and expansion of our revenue. There's lots of things happening. It's a 2025, 2026. Because remember, the first thing we had to do was build out the infrastructure layer. That's what's happening now, and get enough power. And then companies and enterprises are thinking about how they can use Gen AI to drive efficiency. So it's a kind of next year and beyond. But again, we saw this in the 90s. We saw productivity, and that will be key to watch, because otherwise the economy might just run too hot here.
Right.
So that's one of the risks, getting back to your question.
Nancy, thanks for being here. Great to see you.
Yeah,
Appreciate
likewise. Delighted.
Coming up, we're going to check in on clean energy stocks with an analyst who just upgraded Sunrun. That's next on Market Catalysts. Shares of solar energy installer Sunrun are slipping today, but we have seen a big run for the shares as of late. The stock got a boost from an upgrade as well at RBC Capital Markets to outperform from sector perform and a price target raised to $16 a share. The analyst saying guidance changes from the One Big Beautiful Bill could have positive implications for the company's growth. Joining me now, the man behind that call is Chris Dendrinos, RBC Capital Markets analyst. Chris, it's good to see you. So we got this new guidance late last week from the administration about the sort of details of how we were going to time construction for solar projects. And this is pretty weedy, right? So as simply as you can you explain to viewers why this is so important, not just for Sunrun, but for really the whole solar and whole clean energy industry?
Yeah, you asked the most challenging question, because this is it's very confusing to explain it in simple terms, but I'll do my best here. And basically what happens is there's a concept called safe harboring. And so, the deadline for these projects to go online and collect a IRA tax credit is year-end 2027. But if you start construction before then, it can get you basically locking in that credit until sometime in 2030. And so what these companies are doing, and what the Treasury guidance did, was clarify the rules around that ability to commence construction and sort of lock in that credit. And so for Sunrun, what's very important here is it gives them, from this point forward, basically out into 2030, visibility on the ability to collect these tax credits and kind of continue to sell the product the way that they were selling it.
Well, and correct me if I'm wrong, Sunrun, is it primarily a residential installer or sort of a bigger scale installer?
Yeah, so they solely do residential installations, and the key kind of component to this, if you were to divide up the market into two segments, one is sort of a cash sale or a loan sale, and the other one is a lease sale. And with the residential solar market, as part of the OB3, they terminated the credit that was for a cash sale. Sunrun's business is 95+% lease sales. And so the whole, half the market, half the demand that was going to a cash sale, in theory, could now migrate to a lease sale model, which is what Run's offering. And that's a huge opportunity for them to collect more market share. So, the upgrade's predicated on this idea that they have visibility for demand and the ability to collect tax credits for, out into 2030. But secondarily is that they're in a position here to capture a lot of market share and actually grow next year, when the industry as a whole actually probably contracts because half the market is losing a tax credit.
I guess what I don't understand, Chris, is if we're talking about when a construction project begins, or when a project begins, like an installation of solar panels, that takes a day? It doesn't take very long. So I guess I'm confused, like if they have to start this by, in the next year and a half or whatever it is, to get the credit through 2030, most of their projects are really short, right?
Yeah, so, and this comes down to what is defined as sort of commencing construction. And for residential solar, there's two ways to do it. One is called, physically shovels in the ground, which means you're commencing construction. It could be either manufacturing something in a factory specific for this, rooftop, or in Sunrun's case, in residential solar, this case broadly, you're spending 5% of the project's total capital cost up front. So what Sunrun does is, they may not even have a customer. They don't have a customer, but they can go out and secure supply to eventually put a panel on a rooftop. And by spending, 5% of what would be the total project's cost, they lock in the ability to collect that credit. So, to your point on it being, short cycle projects, et cetera, it doesn't necessarily really matter. It's more just, I've bought a solar panel that gets me a credit out into the future because I've spent 5% of a project's cost.
Gotcha. Like I said, weedy, but the bottom line is you think Sunrun is going to benefit from all of this. Do you think in general are the solar installers in a better position based on this guidance than the solar panel manufacturers?
Yes, I would say so, and specific to the residential side of things, and as I kind of mentioned here, like Sunrun's in a position to grow its market share and grow its customer base next year. But half the credit for residential solar is going away, and so they're depending on who you listen to or your forecast, the industry could drop by 20 to 40% of demand next year. And so those panel manufacturers that are selling to rooftop solar are probably in a position where they're going to see demand fall, which that's kind of what our expectation is for the suppliers that supply Sunrun, which would be like an Enphase or a Solar Edge. I think their demand drops next year, but conversely, Sunrun, because they're servicing the segment of the market that continues to collect the residential solar credit, they grow. And so, yes, the panel manufacturers, I think, are in a very different position from Sunrun right now.
Chris, really interesting stuff. We're going to keep tracking these stocks and track the changing guidance as it does change. Appreciate your time.
Yeah, thank you.
Thanks. We got much more markets action coming up. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tabama. We are live at the NASDAQ. Let's get a quick check of the latest market action. We're about 1 hour into today's trading session. If you take a look at all three major indices, it's a bit of a mixed picture here as we make our way into this week, with all eyes on that speech from Federal Reserve Chair Jerome Powell set to happen at 10 a.m. Eastern on Monday from the Jackson Hole Smithsonian. Now, if you take a look, the Dow is gaining the most momentum in this early morning trading session here. Once again, about 1 hour into the market open. The Dow leading the way here, up about 0.5%, and a bit of a reversal from what we've seen so far this summer. The NASDAQ leading the downward momentum, down more than 0.4%. The S&P 500 roughly in the flat. But I also do want to point out the Russell 2000, especially after we got a note from B of A's Savita Subramanian. She said that she thinks a shift to value and small cap stocks may be coming, and we've largely seen that index up about 6% over the last 12 days. Once again, the NASDAQ only up about 4.2% over the last days, as maybe there's a bit of a risk off instead of risk on environment among investors right now. I do want to take a look at what exactly is leading the momentum here for the NASDAQ, but not necessarily translating to what we're seeing. Intel, they did announce that SoftBank is investing $2 billion stake at $23 a share. Also, the government reportedly considering a 10% equity stake. That has Intel leading some momentum here, up as much as 10%, now back down a bit, still up nearly 9.5%. Also, the Dow, I do want to take a look at that equal weight here. Home Depot coming in up about 3.5% although the company reported a miss on revenue, earnings, and same-store sales growth, they also reiterated their guidance. Some investors and analysts on the street saying, hey, it could have been worse. They could have reiterated, or rather cut their full year guidance. Instead, they reiterated their guidance. They also said on the earnings call that they're beginning to see some momentum, with same-store sales growth up about 3.3% in July. And once again, if you take a step back and look at all three major indices, a mixed picture here. All eyes are really on that interest rate cut baking into the markets here, potentially happening in September, but we're hoping to get more from Federal Reserve Chair Jerome Powell on Friday morning, and certainly all eyes will be on that speech, as hopefully investors are baking in that rate cut in September. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Palo Alto Networks, Viking Cruises, and Viking Therapeutics. First up, Palo Alto. That stock shot up in morning trading after the cybersecurity company reported strong fourth quarter earnings that outpaced estimates. That included strong margin growth and a 16% increase in quarterly revenue. And the company anticipates continued growth with a positive outlook for fiscal 2026, fueled by AI-driven demand in cybersecurity solutions. Next up, we got Viking Holdings. The river cruise operators hit some turbulent waters. The company posted second quarter results that were in line with Wall Street estimates. It did say advanced bookings for 2026 were up 13% from a year earlier, but investors questioned the company's pricing power and whether demand for Viking's luxury cruises can stay ahead of its major expansion plans. The company said it's committed to taking delivery of more than 24 additional river ships by 2028, increasing its total to 112. And finally, shares of Viking Therapeutics fell sharply, losing more than a third of its value on mixed results for its weight loss pill. Patients who took the daily pill for 13 weeks lost on average up to 12.2% of their body weight. That translates to 26.6 pounds. But a fifth of patients taking Viking's drug dropped out of the study due to side effects, the most common of which were gastrointestinal related, which has been seen in other drugs in the GLP-1 category. And as always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're navigating how to play the buy now, pay later trade amid rising adoption and a higher interest rate environment. Asking for Trend host Josh Lipton sat down with Dan Dolev, senior financial technology analyst at Mizuho Americas, to discuss the sector as part of the investor playbook.
U.S. say retail, we're talking U.S. e-com is about $1 trillion business. Buy now, pay later today is probably pushing like 70, 80 billion. It's tiny compared to e-com, and it's even smaller if you think about total US retail, which is like 7, 8 trillion, right? So it's big, it's growing fast, but it's still a very small fraction of the overall opportunity.
Who is using buy now, pay later? Do we have line of sight in there? I'm prompted a lot to use it, but do we have any kind of line of sight to just the average demo, Dan?
Yeah, so what's interesting is it's got the reputation of being, steered more towards like people that don't have access to banking, et cetera. But it could be anyone.
That is the rep for sure.
That is the rep, right?
Yeah.
But I think it's a little bit misunderstood because remember during COVID everyone was buying Pelotons on Affirm, and that was like your neighbors, right? It wasn't only people that don't have access to credit. So I would say it's mostly skewed younger. So if you think about it, this like 18 to 34 cohort. Kind of right where I am. Just kidding. That 18 to 34 cohort, younger, and I would say just younger. I think there's a preference. I wouldn't say necessarily not as wealthy, more younger, and that's the key thing. Young people don't trust credit cards, don't trust banks. This is a very big lure for young people.
Let me ask you this, because we talk on the show about concerns about the macro and whether the economy could get kind of weak here. To the extent that the economy does get wobbly, Dan, that would mean what for BNPL, the industry and the players?
So the rep is it'll go bust.
Right.
Right? So we hear that all the time, right? I'm an analyst, I cover all these names. The rep is like it's never been tested in a bad macro. We think about this a little differently. Because it's never been tested, it could go both ways. And one of the things to consider is that it could be somewhat counter-cyclical. And let me explain. The reason it could be counter-cyclical is because it helps companies make conversions. So it helps e-com retailers sell something they couldn't sell using a regular credit or debit card. So if the macro turns south, there is a possibility that merchants are going to want to convert more. So they're going to basically steer consumers more towards buy now, pay later. So there is we've never seen this before because it's a new industry, but it's just as equal or just as likely that it would be counter-cyclical and thrive during a worse economic environment.
Let me ask you this, as the BNPL market grows, Dan, what kind of risk, what kind of challenge does that pose to other names you cover, specifically the credit card names?
So it's really, as the buy now, pay later market grows, it really mostly hurts the banks. So the banks, like the JP Morgans of the world, et cetera, because they are the ones that are extending credit today. It does not really hurt, say, Visa or MasterCard, because all these BNPL transactions are actually getting settled using debit. So they're actually turning one transaction, like Visa is turning one transaction into 4, because you have to pay like 4 times. And Visa makes money off of every transaction. The real short end of the stick is coming to the banks. Like the current incumbent credit card operators, like the banks, basically.
Let's get some picks, all right? Give people some opportunities, some names. Affirm, you say, is still a buy. Stock's up about 30% this year. Why is it still a buy here, Dan?
The TAM is unlimited and the execution is epic, right? So you don't often get that sort of
Max
combination.
Levchin's execution is epic.
It's max execution, right? There's literally like 2 or 3 companies in our space where you have that perfect marriage between a great idea, great execution, and product velocity. That's Affirm and Robinhood, right? Those are the 2 names that you could basically say they've got it all. And when you talk to Max, he just tells you, I'm all about taking risk. And I think that's the key differentiator between them and Klarna, right? Compared to them, Klarna looks pretty pale, right? Klarna, which is the other big...
How so? How does Klarna look pale?
Because they're mostly doing buy now, pay later or pay in 4, whereas Affirm has a plethora of different offerings. They can do pay in 4, pay in 6, interest bearing, non-interest bearing. Underwriting those is much more difficult than underwriting sort of the basic pay in 4 that Klarna does. And so if anything, let's say gets weaker as the economy goes south, if it does, we don't know. Right now things are great. It would be sort of the more simple pay in 4. So Affirm has still a lot of like future potential because of that specializing in this like interest-bearing loans, which are the key, the hardest thing to underwrite.
What about PayPal? You say that one's a buy here too. Now that one, we're down about 20% so far this year. What are the catalysts that move that one higher?
So it actually ties everything goes back to sort of buy now, pay later, right? Like everything is sort of, so buy now, pay later, and I'm actually really glad you asked it because buy now, pay later is part of the new branded checkout button. And so as buy now, pay later grows faster, right? And their plans is for buy now, pay later to grow in the 40s over the next 2 to 3 years. That should actually accelerate the branded checkout button growth. And by the way, what I'm hearing is they're crushing Klarna in Europe.
Crushing Klarna.
Crushing.
Yeah.
Merchants are rolling out the red carpet in front of PayPal in Europe.
Interesting.
And so as this does better, the branded checkout button is going to accelerate because it's part of it, right? They're offering like a much better value proposition, right? They don't put you on some sort of a marketplace. They don't charge you affiliate fees. So merchants love it, and that's why they're gaining share.
I have to ask you this one last question, my friend.
Sure.
I think I have this right. I think you only have, Dolev, one underperform. I think you only have one sell. It's Circle. How come Circle is a sell? Isn't this the great way to play the mega trend of stablecoins?
I had to, it's a sell, but it's like a sell with passion. It's a very passionate sell.
The best kind of sell,
It's
really.
the best kind of sell. I'm very excited about this sell opportunity. It's so special.
Excited about an underperform.
And it's so special that I have
it.
one of them, right? It's sort of like, it's like gold. I treat it like, they get a very special treatment in our little franchise. I tell you, the one fallacy about Circle is like rates go up, go down, their revenue goes down. The distribution of USDC, which is how they make money, is basically flat at $68 billion. It literally only moved like 10% since April, right? And distribution costs, which is what they have to pay to Coinbase, Binance, God knows all these apps that are proliferating the USDC, is actually is getting worse and worse over time. So you're getting basically like a confluence of different forces. There's almost no chance that revenue is going to be what people think it is by the end of the year. I mean, unless you think that rates are going up and that they're going to gain share from Tether, which is not happening. So basically 1 minus everything you think, that's what's going to happen with Circle. So it's a very passionate
underperform,
underperform.
passionately buy on Affirm though, I think. Is that fair?
Exact inverse.
The housing market is on ice. Homes this summer selling at the slowest summer pace in a decade. That's according to Redfin. Higher buying costs and economic uncertainty is prompting homeowners, especially seniors, to stay put. That's opening up major opportunities for lenders poised to benefit from home equity lines of credit. Joining me now, Meredith Whitney Advisory Group CEO. Meredith, it's good to see you. And it's been a while since we really zoomed in on home equity lines of credit. But that was the subject of a recent note that you put out. And I thought it was really interesting in this environment. It makes sense that we would see those numbers tick up. And as you noted, we're seeing a pretty dramatic increase in those types of loans.
Hi, Julie. It's great to see you. So home equity has been a focus of ours for a little over a year now. And what we noticed last summer, midpoint last summer, was a dramatic change in home equity lines of credit. So home equity has been a shrinking asset class for 17 years. So banks have either entirely pulled out of the business or they've been de-emphasizing the business. So the market has gone from over 700 billion down to about 200 and at bottom probably around 250 billion. So that's a 17-year trend. Last summer, that reversed. And in fact, since last summer, the trend has only been accelerating. So now home equity is the fastest growing consumer loan category of any. So student debt has stayed constant. Credit card debt has not been growing. Mortgage cash out refinancing mortgage activity has remained decent, but home equity has really been the power engine of consumer lending. Now, the other thing that's happened as of last summer is private credit has come in, actively pursuing these loans. So you have a confluence of demand increasing and then liquidity firing on all cylinders. So there's been over $42 billion in forward purchase agreements for home equity and personal loans, long duration assets, and that's just what's reported. So it's probably double that what's not reported. So Rocket, for example, has been an incredible stock this year. Their home equity business is up over 70% from last year. Another company that's soon to be acquired by Rocket, Mr. Cooper, their activity is more than double last year. SoFi has been an incredible stock this year. They're just beginning to really accelerate their home equity business, and their personal loan business is extremely strong. They have, I think, I believe it's over $12 billion in forward purchase agreements for that product.
So, Meredith, as we sort of illustrated in the introduction to you, some of this is being driven by older Americans who are living in the homes they've been living in for decades, but with rates where they are right now, they can't necessarily afford to sell and buy another home at a relatively elevated mortgage rate, right? So once rates start to come down, will you see that sort of opening up, and will you also then see these home equity line, that business sort of fall out of bed, as it were, at a certain point?
I don't think so. It's unclear what seniors will do. What the AARP says is that most seniors want to stay and age in place. And we estimate that 60% of US homes, and this is based on census numbers, are owned by seniors. So that is such a massive amount of inventory that's not moving. And I think that's why you have such a stuck real estate market. So existing home sales are tracking to be the worst in over 25 years. So you just don't see any activity. And that's because of high prices, that's because of high rates, but most importantly, it's because seniors aren't moving. So there's just not, there's a little bit more inventory on the market, but there's not enough inventory on the market to really move prices down to an affordable level. So the actually carrying costs of owning a home is more expensive than renting. So I think what you're seeing is more seniors are able to stay in their homes because they're tapping into the equity in their homes. So 79% of seniors own homes, and 76% of seniors own homes without a mortgage. So you've got a huge piggy bank to tap into. 41% of all home equity debt is held by seniors. And that has been, that's up from, I believe it's 12% in 2000. So it is grown, 17% in 2000. So it's grown dramatically. Somewhat counterintuitive, because you think as you get older, you get more conservative, you have less debt. But because of cumulative inflation, it's becoming incredibly expensive to own a home, and ICE accounts for the fact that property insurance, homeowners insurance, has gone up well over 70% in the last 5 years. So, and then property taxes have gone up dramatically. So just the carrying costs, along with everything else of owning a home, is expensive, but they're able to stay in the homes by tapping into the home equity. I think that home equity is only going to accelerate from here.
Are we, though, at the same time going to see a wave of defaults or foreclosures in some cases with these folks if they outlive these loans, for example, or if they need to pay for expensive health care, even if they're staying in their homes? I guess what I'm asking is, how risky is this type of debt that we are seeing, grow so much?
It's actually the cheapest form of debt next to a mortgage. So it's cheaper than credit cards, it's cheaper than personal loans. And what's really different, because I'm always asked about how close are we to the last crisis, because I was so active in the last crisis, in particular around housing. If you look at loan to value ratios, they're half of what they were in the last crisis. So the average loan to value in the US is just over 20%. It was over 50% in the crisis, and of course, a lot of homeowners were upside down, and that's what caused a race to foreclosures and people losing homes. But it's nowhere like that. So I think that you have people who have built up a tremendous amount of equity, and why not tap into it? I can. Where I was very cautious on the housing market going into the crisis, I'm actually very bullish on the equity in homes and a safety net for so many people. Home Depot reported this morning, and they talked about this trend that people are doing small types of renovations, but there's so much more they can do by tapping into their home equity. So Home Depot had a great quarter, and their guidance was very strong. We actually wrote about this yesterday, anticipating that. But another thing is, homeowners are, the economy's bifurcated, right? The high end has been supporting so much of the economy, but homeowners, and Home Depot said this in their earnings call today, homeowners are just a much better credit and spending customer, and that's the bulk of Home Depot's customers. So I look at U.S. consumers and divide it down to who owns homes and who doesn't, and the folks that don't own homes really have no safety net.
Well, and Meredith, I guess that helps sort of go in the direction I was going to go, which is the final question, which is, what's the downside of all of this? Or who is there a downside for? Where is the risk? Because there's got to be risk somewhere as a result of some of these trends.
Oh, I think that one clear risk is the fact that the first thing people do when they take out a home equity loan is home repairs, but they also pay down debt. So you see credit cards not growing, and they haven't grown in several quarters. And I think that the subprime credit cards are suffering. So if you look at Bread Financial, if you look at Synchrony as an example, and Capital One on a standalone basis, their credit card balances are not growing. So I think that's where you see the weakness. It's not necessarily risk, it's just they're going to have a difficult time generating revenues because of lack of growth in their portfolios.
Meredith, it's good to see you. Good to get your perspective, as always. Really appreciate it.
Great to see you, Julie. Thanks.
Coming up, retail earnings off to a lackluster start with Home Depot missing estimates, but the shares are trading higher. We're going to take a deeper dive into the numbers. That's coming up in the next hour of Market Catalysts.
Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves for your portfolio. I'm here now with Washington Crossing Advisors Senior Portfolio Manager Chad Morganlander. Chad, great to see you. Let's start with what you think is a buy. And this name is Alphabet. Analysts, I got smart analysts on the show, Chad, and they'll say, listen, they like this name. They'll say advertising's resilient. They'll talk about the cloud momentum. They'll say healthy margins. But let's see the reasons you think it's a buy. We'll start with bullet point number one. You say strongly positioned for future growth.
Without a doubt, we think that the search property is going to be layered with AI, that's going to continue to grow and be resilient. Also, you have Waymo, which obviously is dominating the autonomous driving market. And then they have DeepMind, which is the artificial intelligence backbone, which is really going to run the entire company going forward.
Bullet point number two, you say Alphabet's a buy because search should continue to be resilient.
Yes, I mean, all you really need to have happen here is search to grow by 8 to 12% year over year to actually move the stock price higher. Mm-hmm. The overriding concern is that there's going to be more competition, and that is one of the reasons for the multiple being so compressed.
Final reason you say Alphabet's a buy, power from Waymo, YouTube, DeepMind.
Yeah, okay, so you have to understand that we've got ourselves in a situation where Tesla is valued at over $1 trillion because of Tesla's big push towards autonomy, as well as robotics. Mind you, the Alphabet is actually doing it, and they're successful at doing it at this point. So we think that the valuation for Alphabet is artificially compressed. Also, when it comes to DeepMind, they play the long end of this long ball kind of game here, where you have ChatGPT that perhaps is moving quick and fast. They're trying to break things. We think that the DeepMind team is being more pragmatic about it, that they're going to embed all of their stuff into their services, and it's over the long run going to keep this company much more competitive with the likes of Microsoft as well as with Tesla.
Now, those are all the reasons to buy, Chad. Before people buy, all pile in, right? Let's talk about some risks you think they should consider.
Right. Obviously, ChatGPT has been the belle of the ball, and they continue to be that. We think, though, that if ChatGPT was to get into search, that would be the major risk, the tail risk that we're talking about here. And then when it comes to regulatory issues, we have in August, which we're in today, a judge that's going to come out and try to, perhaps bad news, dismantle their browser or whatnot. We think that that's going to be an extended kind of argument that's going to be held up in the courts for a couple of years. So we don't generally think that that's going to ruin their business model as of yet. And then, of course, the whole thing about not being able to convert their IP to durable growth. Back in the 90s, I was acutely aware you had companies like IBM, like Lucent Technologies. They had the best internal labs. They were not able to monetize all of that knowledge into real workable products.
All right, so we're going to buy Alphabet. Let's get to one you would avoid. You would avoid Robinhood. Now, this one, Chad, most on the street, they still like this name. It has had, look at the chart. It has had, it's up 200% this year. It's up 460% over the past 12 months. Let's go over the reasons you would avoid it. One, company's valuation, silly, Chad. It's silly.
Market cap is $100 billion. We've experienced this before back in the 90s with E-Trade and Ameritrade. That doesn't mean, and I don't want to take away that the company isn't a well-run company, but what's going on here is that they're getting a tailwind from not only day trading because of the retail investor, kudos to them, but also the crypto surge. Eventually, that's going to decelerate. Hence the reason why we're somewhat more concerned about the valuation. Goldman Sachs, market cap's 250 to 225 billion. This is 100 billion because of the gamification.
Second reason you would avoid this one, no wide moat relating to competition.
Yeah, the reality is that Goldman Sachs or Morgan Stanley or others like Charles Schwab could just price them out. This is not as if they just invented another GLP-1 drug. This is a very competitive market environment. And also, one has to keep in mind, the stock market goes up and then goes down because of credit spreads and malfunctioning markets from time to time. At a $100 billion market cap, you're really in nosebleed territories.
Third reason you wouldn't go near this one. Let's look at sensitivity to retail investor base.
Yeah, look, I'm not taking away the retail investor into the marketplace, and I don't think that the retail investor is the silly money at all. That's not the case. I think they're quite wise. It's just that at one point, when you have credit spreads that are so historically tight and equity risk premiums that are so historically low, and a crowding of the market, it's just a very dangerous spot for the retail investor. And we believe that can perhaps, like the seasons, come in and out. So we would just be somewhat more circumspect about this company.
Let's end here. How could you be wrong, Chad, on Robinhood?
Well, how could I be wrong? Valuations have to come down considerably for us to be more mindful about buying it. I would have to say that perhaps there's a continual surge of equity enthusiasm. I don't think we're right now at the top of the market in regard to what it was like in 1999. Maybe we're 24 months away from it. Remember, the S&P got to 33 times. We're at 24 times now. So there could be some more speculative fervor before there's a reversal of that.
All right. Buy Alphabet, avoid Robinhood. Thank you, Chad. Thank you all for watching. Goodbye or goodbye.
Coming up this hour on Market Catalyst. First up, U.S. stocks searching for direction as investors size up the Fed's next moves. Full market coverage is coming up. Plus, we'll hone in on investing in the cannabis industry amid reports the president could reschedule the substance. What would that mean for cannabis stocks? And how is the president's trade war affecting home improvement and renovations? We'll discuss that and more on Market Catalyst. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets now. First of all, the major averages, where we're seeing even more of a sort of bifurcation between the Dow and the NASDAQ today. The Dow actually touching an intraday record. It could close at a record today, and it's up about 1/5%. On the flip side, we got the S&P 500 down 0.4%, and the NASDAQ in particular is under pressure today. It's down by about 1%. So definitely seeing tech underperform in this session. Well, President Trump is considering reclassifying cannabis as a less dangerous drug. That's according to several reports. The move would take marijuana from a Schedule I drug, a classification it shares with heroin and LSD, and make it Schedule III, which includes drugs like ketamine, steroids, and testosterone that are also seen as having medicinal uses. The news sent shares of cannabis companies surging, the likes of Tilray, Curaleaf, and Trulieve all up in the last week. Joining me now in the sector is Tim Seymour, Amplify ETF's portfolio manager. He has long managed an ETF that's in cannabis. Good to see you, Tim. Thanks for joining us.
Hey, Julie. Great to be here. Thanks.
You know, I want to take a step back and look at cannabis here because, man, it's been a tough road. I know that you've been in these stocks for a while, and periodically you get these like spurts of interest from headlines or what have you into these stocks, but over the longer term, it's been tough. What has been the biggest challenge? Let's start there for the cannabis industry. Has it been the federal prohibition on cannabis, or are there other fundamentals that have made it tough?
There's no question that the macro environment around federalization or lack thereof, any support within Washington, seemingly a political constituency behind it, and then suddenly that constituency can't get through pretty traditional, either hard line on the other side that will never listen to a cannabis argument. That's been the story over, we're now talking about multiple presidential administrations that have presided over what has been a growing top line and a bipartisan political support for cannabis consumption trends, all the exciting things that investors would want exposure to, and the backdrop, which is that it's not terribly controversial that cannabis is understood and accepted on the consumer level, on the medicinal level, on the social level. We've had the war on drugs, ultimately, I think, been corrected, restructured, refocused, that it wasn't necessarily where we thought the war was. And so some of the social justice around that. But I mean, to drill back into your question, it's a lot of the inconsistency of Washington. It is some of the dynamics of the cannabis industry itself that are structural, but a lot of it is dictated by the fact that this is federally illegal. It means that every state that legalizes a cannabis operator essentially has to set up differently in that state than they might in another state that's approved them. So it's a very asset-heavy industry. It's an industry that a lot of critics would say, hey, ultimately there'll be price compression. I mean, this is a plant. It's called weed for a reason, right? Like anybody can grow it. And there's dynamics, and I don't totally agree with that. Certainly not on the quality side, but there's been a lot of different ingredients here. And I think then just bringing it to the market side, and as someone that's had a background in emerging markets, and I've spent a lot of time investing in industries, but countries where there was low liquidity, there weren't real exchange listings, there was a lack of institutional sponsorship, there was the inconsistency of the political dynamic. That's one of the things that also is just a big part of why investing in cannabis has been volatile, has been a series of roller coasters. I feel like we've had 4 cycles in the last 6 years, and maybe 8 years, and I've been focused in the space for probably close to 10.
So, okay, so let's bring it to deregulation then and the rescheduling potentially, right? We've heard these reports before, they haven't come to fruition. But why would that be, it wouldn't necessarily be the game changer that full legalization would be. So what effect would rescheduling have on the industry?
Yeah, I think rescheduling is powerful. And I think you don't need federalization to have a big impact for the industry. And we'll talk a little bit about what the markets have done in a second. But there's no question cannabis markets have applauded this every time it's been brought forward. But in essence, because it's a Schedule I drug, as you mentioned, like LSD or heroin, without medicinal value, it's taxed in a putative way. There's something called Section 280E, which in the IRS code means that traditional cost of goods sold cannot be subtracted. Profitability as measured by a traditional either CPG brand, a company, but even traditional accounting becomes impossible, becomes such that these companies almost by structure cannot be profitable with 280E. So by removing this tax dynamic, you unlock enormous amounts of free cash flow for the industry. There's no question, there's different measures out there, but right now what the companies have on their balance sheets as payables to the IRS. And I think most companies, by the way, are working with the IRS, even in the construct of where there could be change. I think a couple of the biggest players have regular dialogue there. That actually, as an investor, makes me feel better. I don't think they're skirting IRS law, but there's $2.5 billion, there's $3 billion of IRS payables on the balance sheets of these companies. What happens with that, we don't know. But the look forward is these are companies that could be highly free cash flow generative. I also just think that this type of follow through from the Trump administration, which we thought we were going to get with the Biden administration and even Trump 1.0, to be clear, when the world was a lot less clear on cannabis, you had an attorney general that let the states do what they want to do. If you got rescheduling, I think you were going to continue to see some dominoes fall in terms of maybe even the legislative process. But if we just got exchange listings, could we trade on the New York Stock Exchange? CNBS is a cannabis ETF that trades on the New York Stock Exchange, but could Trulieve or Green Thumb or Curaleaf or some of these companies that don't, could they trade there?
Something else I want to ask you is we have a model of legalization north of the border, right? Canada legalized a while ago. And things there haven't been that great for investors either. So what lessons can we sort of learn from that? As both what regulators, what regulators can maybe do, but also what investors can do, because legalization there was definitely not a panacea in terms of getting stock returns.
Well, I think what legalization there was also highlighted the capital markets inconsistencies. So Canadian companies are listed on the New York Stock Exchange and on NASDAQ. American companies are listing on the CSE, which isn't a real exchange, with all due respect. So what it meant were companies like Tilray or Canopy Growth or Aurora, whose addressable market, I mean, the size of the Canadian cannabis market, with all due respect, this is how my mom used to deliver an insult to me. It's smaller than that of the addressable market in California. So I think part of the expectations for the Canadian market were just unrealistic. I think the fact that people wanted cannabis exposure, investors, drove the market caps of those they could invest in the U.S. well beyond what was even sensible, frankly. And that's even on a price to sales basis, let alone profitability and PEs. At one point, I think at its peak, Tilray was a $25 billion company. Now, this company, Tilray is a company that we have a very small position in CNBS, but I will say it's a company that's run very differently. It's a company that also is, I think, focused on beverages. But the core Canadian market for investors to invest around was not really the size of what the market caps were. And I think it shows the funnel that of where there's investment interest in the sector. I also just think that in Canada, because growing conditions are different, the build out, the enormous amount of money spent on capex to build out warehouses, and this funded capacity story, it was way overbuilt. And again, it got to a place where, from the commoditization of the industry, Canada just wasn't that interesting. Be clear. I mean, Canada's doing interesting things. That industry has found profitability. There's a number of players there, but the U.S. market, like it is in every other sector, is the biggest in the world. It dwarfs Canada, and I think that's part of the opportunity here. But you're right to highlight where this was confusing.
Lastly, just real quickly here, your ETF, like anything in the industry, peaked 2021 and has since then effectively collapsed. Sorry, there's
sure. No,
I should use your same caveat.
Sure.
What would
with all due respect?
Yeah, with all due respect, we've seen a collapse across the industry. What would cause it to sustainably not come back to those levels, which is probably not realistic, but to see a more sustained rally?
Well, what I would like to point out is that there's no question that investing in cannabis has been volatile and there's been a drawdown. CMBS, I'm meeting with company management. I'm managing a portfolio that I think is at least the companies that I want to own today as they position for tomorrow. I think if you're investing today, there's, especially in an active fund, there should really be stock selection that's based upon companies that have first of all, the balance sheet. I mean, part of the big issue for investors, especially this free cash flow dynamic, is companies have big debt liabilities that they're coming due. Are you investing in a company that may have to raise equity and be very dilutive? So I just think investors need to think about where they're investing, because I do think a dollar allocated today is very different than a dollar allocated 5 years ago, and thus we're pretty excited about the opportunities here, this growing addressable market, the profitability, that the surviving companies in the industry, the larger ones, I think are very savvy and have come a long way in terms of their operational efficiency. So I've managed through a number of different cycles. I don't wave the pom-poms on this, but a dollar allocated today is, first of all, well ahead of institutional capital. The market has drawn down and put a discount on what I think are the valuations of these companies, but nothing's easy, and this isn't going to be a runaway train, but it's an exciting time now. Stocks are moving. This, and it's not legislation, this administrative action by the Trump administration would be extraordinary and would be a game changer for the industry.
We'll see if it comes to fruition. Tim, thank you so much. Good to talk to you.
Thanks, Julie.
Take care. Coming up, I'm talking to the CEO of Blink Charging on how that company is approaching the EV charging landscape. Shares of Blink Charging taking a hit this morning, falling nearly 9% after the company reported a wider than expected loss in the second quarter. Sales did top Wall Street's estimates, with the company bringing in over $28 million in the latest quarter, but sales were down about 14% from the same period a year earlier. Here with more on all of this is Mike Battaglia, Blink Charging CEO. Mike, it's good to see you. So talk us through the quarter a little bit first, and in particular, I'm curious about that net loss coming in larger than expected, even as sales all beat estimates.
Yeah, thanks, Julie. So first of all, thanks very much for having me. It's great to be here. So number one, I want to emphasize that we're actually very happy with the quarter, and that might sound a little strange given what you just mentioned, but let me explain why. So during the quarter, we had about $16.5 million in non-cash charges. So if you were to remove those non-cash charges, we actually did quite well from a year-over-year OPEX perspective. So removing those non-cash charges, we actually improved our operating expenses by about 24%. Our compensation expense was down 22%. As you indicated right up front, our revenue was $28.7 million, which was actually a 38% sequential increase from Q1. So the only thing I want to emphasize here is that we have a very, very clear plan for the company. We're executing on that plan, and we're going to stick to the plan.
Just quickly, because I want more details on the plan, those charges, those non-cash charges, can you tell me a little bit more about them and whether they are recurring?
Yeah. So those charges are largely one-time, non-recurring charges. So they were principally concentrated in two areas. One area being an inventory write-down associated with legacy equipment that we've discontinued, where we're investing in new technologies to meet the market. So things like obsolete components, some obsolete chargers in there that did not have a viable run rate ahead of them from a sales perspective. So we took those down. The other piece of it was several $1 million in uncollectible receivables. So look, there's no surprise or mystery out there that there have been some bumps in the road with the EV industry overall, EV charging. Some customers of ours have had a tough time, and we were not able to collect on those. The good news is that we're making significant progress on working capital improvement, on collections that remain on the books, et cetera. So those were some of the big ones. Again, largely non-recurring. And again, we're in a good position moving into Q3.
Okay, so Mike, tell me about the plan for what investors should expect from you guys over the next 6 months to a year.
Yeah. So a couple things. Number one, we have a plan that we created at Blink called Blink Forward. And Blink Forward is a comprehensive initiative. It includes a number of different components. But at the end of the day, there's no secret sauce and there's no mystery to what we have to do. We need to lower our expense base and we need to grow revenue. And right now we're doing both of those things. We see a strong pipeline building for the second half of the year, as we indicated on the conference call on Monday evening. And we have more cost that we've identified that we can take out of the business. So at the end of the day, cash is king. We are intensely focused on preserving liquidity, bringing in the funding that we need to operate this company, turning this company into a profitable and cash flow positive commercial business.
And Mike, on the demand side of that equation, on the growth side of that equation, as you mentioned, it's a challenged market out there, in terms of EV purchases in the U.S. That's a factor. Obviously the changing tax credit environment is also a challenge there. So how are you going to get more demand for charging at your stations?
Yeah. So first of all, keep in mind that, and I've said this before, at the end of the day, the consumer is going to decide how this industry goes. The U.S. consumer, which is our principal market, and our secondary market being Europe. Europe has already moved to a new normal where electric vehicles are the car of choice or the drivetrain of choice. The United States is still finding its way in this market. There are a lot of competing motivations in the U.S. market, but overall, when you look at the long-term trend for EV adoption, even under revised forecasts, it's still a very bullish case. So our mandate at Blink, and I think other companies in the space share this, is that we have to become very efficient, very investor-friendly, very well-run organizations so that as the market matures and as it comes back, we're well positioned to take advantage of that upswing. The other comment that I'll make is that I believe that Cox Automotive just came out with a report showing very strong EV sales growth in July versus the prior month. So now we can debate whether that's due to the expiration of the $7,500 tax credit. Some of that probably is, but at the end of the day, what we look at is there's more EVs on the road every day. There's more demand for our charging services as evidenced by our 46% increase in charging services revenue, and we expect that to continue.
And I guess lastly, I would ask, you mentioned you and your competitors. When we think of gas stations, right, where we fuel up traditional vehicles, there are a lot of different brands out there. Yep. What is the landscape? How much room is there in the landscape for multiple players? Or are we looking at a future where eventually there are just 2 to 3 branded chargers? I mean, how do you think this is going to play? I mean, obviously you guys think it's going to play out that there's going to be a bunch and that Blink will be one of them, but talk me how you're thinking through that.
Yeah, no, I actually think you nailed it. So Blink is the 3rd largest EV charging network in the United States behind Tesla and ChargePoint. So we have, in the neighborhood of 20,000 network connected charging stations. The truth is that we think that there is room for multiple companies in the market, but there will also be consolidation in the next 12, 18 months. And ultimately there will be fewer players. Think of, like you mentioned, gas station. You have Exxon, et cetera, Sunoco, take your pick. But we think there's going to be a core group of companies that service that EV charging market, and we certainly expect Blink to be one of those.
Mike, thank you so much. Appreciate your time.
Julie, thank you. Appreciate it.
Take care. Coming up, we'll bring you some of the top trending tickers on the Yahoo Finance platform. Plus, Home Depot reaffirming its full-year forecast. We'll break down the results with D.A. Davidson's Mike Baker. That's on the other side of the break.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live with the NASDAQ. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and it's a bit of a mixed picture when you look at all three major indices. Right now, the Dow holding on to the momentum after it did hit a record high around late of 10 o'clock, 10:50 today. That record high now, if it does hold on, will be a closing record. That record to beat would be about 45,014. So right now, we saw a bit of a pullback, but still holding on to the momentum. On the flip side, we do see the NASDAQ in the red, down about 1%, as there's more calls on the street that we might have seen or been in an AI bubble. We'll get to more of that in just a second. And the S&P 500 also in the red, down about 0.3 of a percentage point after hitting a little bit in the green earlier today. I do want to get to the heat map here, because if we do take a look at the NASDAQ, if we do take a look, there we go, at the NASDAQ, what we're seeing there when we get to equal weight is Palantir leading the downward momentum, down nearly 6%. And this is largely after the company has been getting some of a hit over the past 5 days, down about 12%. They're on pace for their fifth straight losing session. Once again, down about 6% in today's trading session. That was after Andrew Leff, the founder of Citron Research, had said last week that he's betting against further gains for the Palantir stock. On the flip side, we do see Intel up about 7%, largely because of that investment or their stake by SoftBank as well. And then also, I want to take a look at the Dow. Bit of an interesting read there. If you take a look at equal weight, what's actually gaining the most momentum there is Home Depot, up more than 3% in today's trading session after that company gave some excitement to investors after they said that July same-store sales were improving. But once again, a bit of a mixed picture. We take a look at all three major indices, the Dow holding on to momentum while the NASDAQ and the S&P 500 in the red. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Medtronic, Best Buy, and Kohl's. First up, we got Medtronic. It's going to expand its board after Elliott Investment Management became one of its biggest investors. The medical device maker also reported profit that beat estimates and lifted full-year earnings guidance. Still with us, our own Brooke DePalma. Those shares down by about 4% today on those headlines.
Down about 4% indeed. And if you take a look year to date, this stock has seen what has been in a gain of about 11%, but largely over the past 5 years, this stock is down nearly 12%. And that's largely after they struggled to keep up with the demand of procedures post-COVID. We also know that the company, based upon this latest announcement, has said in the earnings call that it would allow them to achieve a higher investment back into the business. They also said that this would allow them to improve margins and accelerate earnings growth. But we are getting some calls on the street about what exactly this stake from Elliott Management does mean. We know that the street has seen some momentum because of the fact that they were going to separate their diabetes business for either an IPO or a subsequent spinoff. Now TD Cowen saying in a note that we don't know whether Elliott has strategic priorities that differ with previous priorities that the company has set out, like this potential spinoff of their diabetes business.
Yeah. Next up, let's talk about Best Buy. That company announcing the launch of a third-party marketplace as it looks for sales drivers. So joining a lot of other companies that do this, right? Walmart does it, Amazon does it. How does Best Buy sort of fit into that landscape, Brooke?
Yeah, well, fit in, or rather hope to stand out. I mean, they're really just trying to gain onto this bandwagon of other retailers that we've seen, like you said, Walmart, Amazon, also Target launching their third-party marketplace, or rather expanding it. It's called Target Plus. And so Best Buy hoping to get in on that momentum. And what's really been interesting is to see this company really get excitement among investors. Right now, those shares are up about nearly 4%. If you take a look at the YF Interactive, it's interesting to see see Best Buy, Home Depot, and Lowe's in the green today after those companies reported. We know that Best Buy has really struggled to hold on to the excitement among investors year to date, especially if those tariff negotiations certainly took a toll on what exactly pricing will look like for the company. Also, Best Buy looking to differentiate itself. It said that this was a strategic priority that they set out earlier this year. Corey Berry had said on a call with investors that they plan to launch and scale incremental profit streams, including this Best Buy marketplace. And so they're hoping that this incremental profit, as we've seen with other players like Walmart, will help Best Buy ultimately boost in the back half of the year.
And let's stick with retailers. Taking a look at Lowe's, that company is getting a boost after Home Depot came out with its results. So what are investors looking for from Lowe's?
Yeah, well, what Home Depot told us is essentially what investors are hoping that we'll see from Lowe's tomorrow, and that's why you're seeing that stock up of more than 3%, nearly 2% today, but up about 4% year to date, and certainly gaining lots of momentum over the past month, up nearly 17%, largely because investors are hoping that as interest rates potentially lower in the coming months after that September Fed meeting, also this return to DIY projects that will sort of reignite the consumer, the DIY customer at Lowe's. We also know that Home Depot reported a increase in same-store sales growth. Investors, or rather analysts on the street, are also hoping for about the similar same-store sales growth from Lowe's tomorrow, and it'll be interesting to see what they have to say about their full year forecast. We know that Home Depot reiterated about a 1% same-store sales growth guidance for the full year, and back in the first quarter, Lowe's had set out for the same, and so both those are top of mind going into tomorrow's report.
Definitely. We'll be looking forward to it. Thanks, Brooke. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Home Depot missing on second quarter earnings and revenue as consumers pull back on large projects. Still, the home improvement retailer reaffirmed its full year forecast. Joining me now, Michael Baker, D.A. Davidson Managing Director and Senior Research Analyst. Mike, it's great to see you. So, a little bit of good, a little bit of bad here. The stock is going up. What was your read on the numbers?
Yeah, the miss was really small. The same store sales missed by like 10 basis points, and it was the best comp that they've had in about 2 years. A lot of the underlying metrics are showing, better demand. Not where we were, many years ago or during the pandemic, but certainly a lot better than the post-pandemic era. And again, the best in a couple of years. The earnings miss 3 pennies, just a little bit of a higher expense rate and sort of noise, if you ask me. This is more just about the better trend and underlying demand that we're seeing, combined with the idea that we think the Fed's going to get more hawkish, particularly when Jerome Powell's term is up and the administration puts in a new Fed chair. We think we'll see lower Fed funds rate, and that doesn't always translate into a lower long end of the yield curve. In other words, lower mortgage rate. But generally speaking, if you apply the average spread between the Fed funds rate and the 30-year mortgage rate, that would dictate that rates will come down. And if we see mortgage rates, they're already in the mid sixes, which is down from where they were. And if they were to get to low sixes, maybe even a high 5, that's really going to drive demand. And I think that's what investors are looking ahead towards.
Well, to that point, I want to read for you a quote that our executive editor, Brian Sozzi, spoke with the CFO of Home Depot, Richard McPhail. And he talked about rates. He said, our customers are looking at long rates right now. We think that the most important borrowing rates for our customers are mortgage rates and HELOC rates, home equity lines. They are still quite elevated, he said, to recent history. And we know that is leading our customers to defer large projects. It's hard to say what rates may have to do to unlock that spend, but our customers do tell us they are deferring, they're not canceling. I mean, and this goes to the question of across anything having to do with housing right now, Mike, which is, what rate is low enough to unlock everything that's frozen? What rate are you looking for?
Well, there are a couple ways I think about that. One is that, true, there's still a little bit of lack of spending there, but it's not getting worse. In fact, it's actually getting a little bit better. So sure, there's still a lot of pent-up demand, a lot of lack of these big ticket purchases. But Home Depot does disclose their comp sales for tickets that are $1,000 or higher. That was up 2.6%. It's actually the best it's been in about 3 years in the post-pandemic era. So you're starting to get there. A long way to go. to answer your question more directly, what kind of mortgage rate do we need to really start to unlock some demand? I think a 5 handle. I think something with a 5 would really start to drive some existing home sales growth, which has been very weak. 4 million or less. We'll get the latest number on Thursday. That has been weak. Interestingly, though, pricing has been very strong, and I think it's pricing that drives the HELOC data, the home equity loan data, and that's at record highs right now. It's just going to take maybe a little bit of a lower interest rate and a little bit of an impetus to get consumers to spend on that equity in their home.
So to go back for a moment to the comp sales chart that we put up a few minutes ago for Home Depot and the big pandemic surge that we saw, then the negative, like what is the normal level for Home Depot, do you think? What's, whatever normal means, and when do we get back to that? Or have we gotten past that inflection point?
Yeah, if I had to pick a normal level, I'd say 3.5. We should get a percent or two from increased transactions, a percent or two from higher pricing, and that historically should all translate into somewhere in a 3 to 4% comp. That's the right long-term level we think for Home Depot. That's where we were prior to the pandemic. You had a big bubble in 2008 or prior to 2008, then a big crash. But generally speaking, over time, it's in that 3 to 4% range. It's been a while since we've been there, but we think that's where we're tracking towards. So 1% comp this quarter, the best it's been in a couple of years, but still a long way to go. Nobody's buying Home Depot today because we think we're sticking at a 1% comp.
Right.
The idea is that we think we're getting ahead of a return to that average level. When we get there, hard to say. But again, mortgage rates coming down, seeing a little bit better demand. The consumer in general is out there spending.
Right.
We think we're getting there. And on our model, at least, we have it towards the end of 2026.
Okay, so still a little ways off, but nonetheless within sight. So now that we've heard from Home Depot, what does that tell us about the rest of the season? Or are we really going to have quite a retail, case by case kind of situation?
Yeah, there'll be a couple. So Home Depot, idiosyncratic, of course, because of the focus on the home, and so it is a read through for Lowe's, and we think it tells us that Lowe's should have a decent comp tomorrow, and at least be able to talk about some signs of better underlying demand. But as it relates to all of retail, there are a couple of themes that we expect to see that were exhibited in Home Depot's results, and we think themes across different retail verticals. It's things like the consumer spending. Again, this is the best comp it's been in a couple of years. We saw this in the retail sales numbers that came out on Friday. We see it in a lot of other data points that we're looking at. The consumer is out there spending. So that's one thing we saw. Secondly, tariffs are starting to show up. Home Depot had a form of price increases that helped the comps. And when I say a form of price increases, what they did is they promoted less. That's a price increase. And they did say that was a function of trying to protect margins from tariffs. So we're going to start to see that. That being said, the tariff scenario right now is, we think the worst case scenario is off the table. Remember when a lot of these retailers last spoke in May, that was coming right off of Liberation Day, and there was concerns of really big tariff numbers. Tariffs are here, they're not going away, but they're probably better than the worst case scenario. And so where that's showing up is that's enabling companies to maintain their guidance because it's no worse than they thought. In fact, it might even be a little bit better.
Right.
One more thing I'd say is inventories. Inventories, we think companies pre-bought. Inventories are going to start to come down, and we do think what we're going to see is a little bit of a conservative inventory outlook for the back half of the year. Retailers are going to sacrifice sales for margins, we think, and really be conservative with their inventory ordering.
That is an important note to watch, sales sacrifice for margins. Mike, good to catch up with you. Thanks for joining us.
Great to be here. Thanks.
Coming up, we got everything you need to know about investing in foreign stocks in the latest episode of Stocks in Translation. Keep it right here.
Here's something that might surprise you. If you're in the US and you own a foreign stock like Alibaba, AstraZeneca, or Toyota, chances are you don't really own the stock. What you own is the wrapper. And on today's Stocks in Translation, we're going to be breaking down American Depository Receipts, or ADRs, the key to having exposure to foreign stocks. So knowing how these wrappers work can really save you a lot of time and money and confusion. So let's start with the definition. An ADR, or American Depositary Receipt, and note that it's an A in depositary, not an O. It's a U.S. traded security issued by a bank that represents shares of a foreign company. Now, you trade in dollars, you get dividends in dollars, but under the hood, it's tied to the home market shares and also the home currency. Let's take the Chinese multimedia giant Tencent as an example. In this chart here, we can see the home shares in blue with the ticker 0700.HK. The HK stands for Hong Kong, and unlike the US, all of their tickers are numbers, not letters. Also in the chart in white is the US listed ticker TCEHY. You're going to notice that the returns are different. The difference is mainly because the US ticker is priced in US dollars, while the home country ticker is priced in Chinese yuan. So it's possible to make or lose money just by how much the dollar fluctuates. If a foreign company wants to list its shares in the US, it works with what's called a depositary bank. The bank in turn works with a local custodian that holds some of the home market shares. And one of the big jobs of the bank is to set what's called an ADR ratio, where one ADR may equal a whole share, a half, 3 or 10, or however many of the home country shares. In our example here, Tencent, JP Morgan is the bank, and they happen to have set their ratio to just 1. So one Tencent Hong Kong share equals 1 US ADR. And if prices drift, arbitrage keeps them aligned. Pros buy the cheaper side and sell the more expensive side until they snap back in line. Then there are 3 different levels of ADRs, which helps determine how and where they trade, along with how the company can use them. Level 1 ADRs trade not on an exchange like the NASDAQ or the New York Stock Exchange, but over the counter or OTC market. That's where Tencent's ADRs trade. Level 2 or 3 means that they trade or list on an exchange, and level 3 alone adds the ability of the company to raise capital or money in the US. And a few housekeeping notes here. Dividends, they start in the home country, and then the bank converts them to dollars after withholding taxes and paying any depository fees. Stock splits show up as ratio adjustments, and when it comes to company spinoffs or rights issues, ADR holders may get a cash lump sum. And note that it usually takes longer for actions that affect the home company stock to make their way to the US investors. So now let's go over some of the risks, and we start with the big one, currency or foreign exchange movements. Even when the company stock does well on its home turf, a strong dollar can eat at those returns. And on the flip side, a weaker dollar can juice the performance. Then we have policy risks, which can include everything from regulatory crackdowns to sanctions and potential delistings. And finally, we have liquidity and hours. ADRs, they trade over US hours. So remember that news can hit one side first while the other is closed. By now, you might be wondering if you can just skip all this ADR stuff and buy the overseas directly. Some brokers allow it, but expect some friction, like extra approvals, foreign exchange conversion, local taxes, even stamp duties. And remember, you're going to be trading during market hours over there. For most US investors, the ADR route is simply the most practical route. Finally, here's your 3-step sanity check. Number 1, map the ADR to the home country ticker. This is simple enough using the Yahoo Finance app or site. 2, compare the long-term returns, which you can also do on our app and site. You want to get a feel for how big the gaps can be due to these currency moves we've been talking about. And 3, check the fine print. Depository fees and ratios, withholding taxes, as well as how your broker passes them through. Bottom line, you're not just buying a company, you are buying a package. If you know the ratio, the currency, and the fees, you can understand what you really own. And when you see the home country and US tickers move a little bit differently, you're going to know exactly why. Tune in to Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts after the break.
The nation's aging housing supply has created pent-up demand for kitchen and bath renovations, but an uneven economy is likely to keep those projects on the drawing board. Joining me, Bill Darcy, National Kitchen and Bath Association Global President and CEO. Good to see you. So we heard from Home Depot today, obviously, and one of the things that they talked about was that high rates are keeping people from perhaps tapping home equity and then spending that on things like renovations. What are you guys seeing amongst your members?
Yeah, hi, Julie. And again, thanks for having me on today and representing our $230 billion industry. Yes, we're seeing the same. I mean, the policy uncertainty, soft employment outlook and this weaker consumer confidence have definitely tempered our expectations. It's frustrating to see this uncertainty, and the tariff headline factor is certainly, I think, keeping some of those consumers on the sidelines.
And so is the only thing that's going to change things for rates to come down and for sort of some of the dynamics to change in the housing market?
I mean, honestly, this is still a very strong market despite the stagflation. I think we're seeing there's a lot of interest. Our members are seeing a lot of interest by the consumers to desire to remodel. And then you have all the structural factors, the demographic trends, and all the foundational excellence that is we know that this pent up demand is coming. We actually encourage consumers to look at these projects sooner than later because we feel the tariff impact really won't be seen until next year as far as a true costs. Or a lot of our members are really trying to not pass along costs to the consumer, but that will only last so long. So again, I think the demand is there, but the headlines, of concerning all of us as consumers, and this is frustrating.
Bill, are you all seeing your members pre-order any inventory to try to get ahead of tariffs and build up that inventory so that when demand does come through that they're ready with that stuff?
We are seeing some members do that with our trade show, the Kitchen and Bath Industry Show, that's going to be in Orlando in 2026. We're seeing a very strong interest in participation from attendants as well as brands. And I think we know the product interest is out there. So introducing new products, whether that's ordering or just a desire to have new products for the consumer, all of us as consumers, I think, want a better place to live in our homes, and our kitchens and baths are at the core of that. So we're seeing still a lot of interest and excitement. And I think that was reflected in what Home Depot was sharing earlier about this deferral mindset. It's not the interest is not there. It's just we're just waiting to see some behavioral change in the market. So we feel confident that there's consistency and we can make decisions as consumers.
Bill, where the activity is happening, are there trends that you're seeing, either geographic or in terms of what people are willing to spend on?
We are seeing definitely as the pro renovations are rising as DIY is declining. So we are seeing this on the higher end, especially. But the consumers, we advocate for this as NKBA. We want everybody to work with an NKBA member, and we hope that they will consider that. But pro renovations are increasing as DIY is declining. I think consumers as they are smarter and they want to get these projects done correctly on time and manage the budget appropriately. We are seeing that occurring right now.
And so to your point, as you said, the higher end projects are still sort of like, is demand holding steady for those?
We actually just recently started to see that flatten a bit. It had been stronger than say mass market, but right now I think it's everyone's getting tired of when are we going to see some adjustments. I heard listened to some podcasts recently about the housing market and how this is a time to really negotiate in housing where you haven't seen that in years. I think that's where the consumer who is on the sidelines is prepared to move forward with the project really should consider doing it sooner, because I think you will see costs increase in 2026, and we'll just have to manage that accordingly.
Any other trends that are on the funner side, or is there anything that you're seeing people do a lot of?
So many of our member companies are introducing new cool products. I think the kitchen, the island's growing. It's taking over that first floor of the home because you have these open plan spaces. Technology is a key part. People who are living in their homes much longer are accommodating those homes to be the best place to live. We still feel this is the golden age of remodeling, despite the headlines distracting us. Currently. The amount of housing structure in the U.S. that needs repair and remodeling. This is those prime remodeling years of the 25 million homes. So there's a lot of still exciting products being introduced that I think consumers will want to have in their homes. And at some point, I think they will get off the sidelines. It's hard to tell right now when that will be.
Bill, good to see you. Thanks for joining us.
Thank you, Julie. Have a great day.
You too. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.